Hello and welcome to our latest investment thinking video. I'm Guido Bicocchi, Director of Investment here at McInroy & Wood, and I'm joined today by my colleague Hugo Swann from London.
Guido, we thought it'd be useful to do this to highlight some of the actions we've taken in portfolios, given the news flow that we're seeing, which is pretty gloomy, both in terms of recent performance of financial markets and in terms of the economic outlook. We've seen interest rates going up around the world as a way of trying to combat inflation, and that's having a knock-on effect on businesses' ability to invest and consumers' ability to borrow, to consume or to buy houses. That coupled with the inflation that we're seeing coming through from gas prices and energy prices, caused in part by the war in Ukraine, paints a pretty gloomy picture. Despite that, the portfolios we've been running for clients have performed relatively well. I'd be interested in hearing from you what you think it is that we've done that has helped this year, and how we've managed to preserve our clients' capital despite the troubling times.
Well, Hugo, I think there are three things that we've done. The first was that we're actually very conservatively positioned coming into the year. So Tim and I talked about inflation and prolonged period of inflation and the effects that might have when we spoke back in February. And so the portfolios had allocations to inflation-linked bonds and gold, and also the companies that we've invested in are able to pass on rising prices. The second thing that we did was look at the outlook for company profits and recognised that with rising costs that was going to affect their ability to make profits, but also with consumers less able to spend discretionary money because they were having to pay more for their food or for their electricity. We felt that that was going to affect the amount that companies were selling. And so we've actually reduced the allocation to equities in portfolios where we have mixed assets back in June, and it's now at the lowest level it's ever been. So that was the second thing that's protected our portfolios. And the third thing was we took those proceeds from reducing the equities and invested it in US dollars and in Swiss francs, which traditionally have been safe havens in times of market stress. And for those of you who've been on holiday, it's been bad news, particularly if you've gone to America, because everything's costing more. But from an investment perspective, actually that's been the right thing to do, because as the dollar has gone up, it's meant that when we've translated those investments back into sterling, then the portfolios have benefited from that.
Great, thank you. Thank you. And you mentioned currency as being a big factor. Does that present opportunities for us as well in terms of certain economies where the exchange rate may have moved a long way and companies operating in those economies may benefit from a change in currency?
Absolutely. So we always think about what's going to drive a change in a currency, and that normally means interest rates, but more readily the economies of the countries themselves. So there are countries such as India where they've been large importers of energy, oil and gas, and because oil and gas is denominated in US dollars, the price of that has increased significantly and affected their economy. But underlying that economy, that country, is a young population which is growing. It's a well-educated population. It's a population where they want to improve and have access to other services and consume goods. They also have the opportunity, as one of the sunniest places in the world, to install things like solar power. So that's something that the government there is looking at. They've spent a lot of money on infrastructure and are planning to spend a lot more. And all of that will help the overall growth of the Indian economy. So that's somewhere that we have already been investing in and will continue to look to invest in.
And we hear a lot about problems with supply chains, and I think that's been one of the things that's driven inflation in part over the last couple of years. Do we hear any good news from the companies that we invest in around supply chains, and is that likely to have a knock-on effect on profitability and perhaps share prices of some of these companies?
We are starting to hear some good news from our companies. So we met with one of them, XP Power, yesterday, And they've been particularly affected by supply chain constraints. They've got factories in China, and the COVID policy there, where it's been complete lockdown, has affected things like ports, and also the ability of factory workers to actually move and get to the facilities themselves. But they're now starting to see that ease, which is helping them, because they're then able to both receive the raw materials that they need to make their products, but also then to pass those completed products on to their end customers, which are hospitals and semiconductor manufacturers. So there's definitely an improving position there. It will take time. The benefit of that to that company is that they are not having to sit and wait for payment for their goods for as long as they were. So it's shortening the production time, and therefore they're able to generate more cash and generate more profits as a result. And ultimately that should be reflected in their share price. We've seen a lot of turmoil in UK politics recently. How do you think that will affect our portfolios, if at all?
Yes, it's been a pretty traumatic time to be a UK politician, I'd imagine. Our portfolios are pretty conservatively positioned, as you said, and part of that for us has meant having relatively little exposure to the UK. We've been concerned with some of the structural problems that the UK economy faces, following on from things like Brexit and other issues. And so we've had relatively little exposure in terms of lending to the UK government, which is one of the key aspects, the key parts of the portfolio, but also in terms of investing in UK companies. The UK companies that are in most portfolios are very international in their nature. And really, we are a global investor, and we want to invest around the world. So having that broad level of diversification has been incredibly helpful to us as we've seen the turmoil in the UK. There's a lot of problems, a lot of problems in the in-tray for the incoming Prime Minister, Rishi Sunak. And he may make a great fist of sorting some of these out. He may not, and time will tell. But I think our approach will always be to try and find very good companies operating in a broad range of different geographies and economies. And certainly the UK companies that we currently own, they have a relatively small fraction of their turnover coming out from the UK as a whole. They're great quality companies, interesting businesses, but actually where they are listed is relatively less important to us.
The immediate economic outlook is gloomy, as we've talked about. When do you think that might end?
So you're asking for the crystal ball to come out, Guido, which is always slightly worrying. I don't think we would pretend to know when it's going to end. What we do feel confident in is the long-term likelihood that economic growth will return, and that human ingenuity will craft a way through this. Stock markets tend to react positively to the very first green shoots coming out of the economy. And so I would expect that a recovery in the economy will come sometime before the economy bottoms out and starts to improve. Whether that's in 3, 6 or 12 months' time, we don't know. But I think given the difficulty that there is in timing an entry back into the stock market, we'd much rather look on a longer term view and say, this is a company that we're looking at, this is a company that we understand, that we can see the growth potential for, and over a 3 to 5 year time horizon, the price we're buying it at today is a good price, and that gives us good returns for our clients. So that's really the way that we think about trying to understand how much money we should allocate into equities versus bonds, which are typically a safer, more stable part of the portfolio, or into gold. And at the moment, we are seeing companies performing very well. There are some interesting businesses that are keyed into long-term themes where there is a good growth rate coming through. But certainly, and buying those companies, even when times are tough, is still a good investment strategy.
Well, thank you for joining us today. If you've got any questions about anything we've discussed, your investments in general, or there are any topics that you think you would like us to talk about in future, then please do let us know. Goodbye.